Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Thursday, February 22nd, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. Big action overnight in NVDA. NVIDIA Corp reported their latest quarterly results, absolutely blew out the estimates. Revenue about $1.8 billion ahead of expectations. Earnings came in more than 50 cents above expectations, which was about 10% higher. And the futures certainly reflect this report. So let me give you a quick update on the futures before we get started. But the diamonds, the DIA that tracks the Dow Jones Industrial Average, up about 0.6% this morning. The Spider tracking the S&P 500 up 1.4%. It's up $7 back to 504.20. We've got the QQQ tracking the Nasdaq 100 up more than 2% this morning, up $8.86. And then we've got the IWM small caps trailing a little bit this morning. I think a lot of the news focuses on the large caps. So the IWM, which tracks the Russell 2000, kind of in the shadows a little bit this morning, but still up about 0.25% this morning. But all in all, it looks like we're going to get off to another really good start. And now the question becomes, do we make that big breakout on the S&P 500? Do we get back through that 5,047 level? Or is this just, maybe just another test before we continue to consolidate and perhaps move a little bit lower? But let's take a look at the action from Wednesday and get started here. Start off with the Dow Jones Industrial Average. It was gained about 50 points yesterday, a little bit more than 0.1%. S&P 500 jumped 6 points. Again, just a little bit more than 0.1%. The Nasdaq 100 actually fell yesterday about 1/3%, losing 67 points. Mid caps up about 0.2%. That was up 5 points. And the IWM dropped about 0.5%, back down around or just below that 198 level. Recently, we were up about 204.5, 205. That's the target. That's the recent high on the IWM, and that's the level the bulls certainly want to clear. The Dow Jones Transportation Average, 15,582, so staying above that 15.2 level. It was up 119 points, or about 0.75%. Moving on to the sectors, energy, the leader yesterday, gaining about 1.9%. It was up $1.59 to 86.38. XLU, utilities, second, up about 1 1/3%. To the downside, though, and there wasn't a lot of weakness in the market yesterday, but technology took another day off. It was down about 0.6%. Moving on to the industry groups, some areas we really haven't talked about a whole lot. Hotel and lodging REIT. So in the real estate area, that was your top performing industry group yesterday, gaining almost 3 percentage points and back near a high that it saw in early January. Oil, in that oil patch, the exploration stocks jumped about 2.6%, moving back up near a 4-month high. So that's certainly an area to watch because energy has been underperforming for a while. Now we're starting to see some strength. Maybe we get a breakout. Maybe energy starts to help in the S&P 500's quest to move to another all-time high. Not performing so well as a familiar group, though, renewable energy. Renewable energy yesterday took a hit of about 2%. The whole group has been really weak throughout much of this bull market advance. And as a result, we now see this index back down below both its 20-day moving average and its 50-day moving average, and not too far from a recent 52-week low. So renewable energy, probably cheap for the long term, but short term still no signs of relative strength whatsoever. Moving on to the 10-year Treasury yield, we did have one economic report I saw earlier this morning, initial jobless claims came in at 201,000 versus the expected 216,000. As a result, you would think maybe we'd have a jump in the 10-year Treasury yield. Not really doing much. We're up less than 1 basis point on the 10-year Treasury. Let me go ahead and get a quick update, make sure I got the latest here. Yeah, almost flat, sitting at about 4.33%. Again, on this chart, the level to watch is your support area right at about 4.20%. That's your yield support. And that rising 20-day moving average now is all the way back up to that 420 level as well. So that is going to be a critical level as we go forward. Probably something we're going to want to watch much more closely when the next CPI report comes out. The February report will be out probably in the second week of March, although I don't have that date in front of me. Moving on, S&P 500. So what we've seen here over the last week and a half has been a pullback to test the 20-day moving average, but we haven't lost it. So this short-term advance remains in play. Another advance today, at least at the open, seems pretty likely. Whether or not we can get back up and clear 5,047 at the open or throughout the day, or especially at the close, remains to be seen. But certainly the early action should be moving back up, perhaps getting ready to test that 5,047 level. The Nasdaq 100 closed just below the 20-day moving average yesterday, but you can see a couple of things here. First, yesterday's action, even though we had that gap down again, we rallied into the close and finished pretty much on the high of the day. So that just reeks of accumulation. And look at the AD line down below. Even though we've kind of come back here over the last week and a half or so, that AD line is setting another new high. So I talk about market maker manipulation in the short term, and this is exactly what it looks like. Prices moving lower, AD lines moving higher, and the major indices generally gaining strength in the afternoons. So what this looks like to me is, even if we do continue to struggle, even if we do fail to make the breakout, it still looks to me like this period of consolidation or even a little bit more weakness ahead will very, very likely be short-lived, as I suspect it would. So that's what my takeaway is from what we're seeing in the market over the past couple of days, and now with this action today. It's going to be critical with this gap up to see whether or not we can hold on to these gains, whether we can make the breakout, or is it an opportunity maybe to see some distribution for perhaps the next couple of weeks. So the gap up is nice, but just like these gap downs meant very little the last few days or even week and a half, does this gap up mean anything? Do we build on it, or do we pull back? I think that latter would suggest that we remain in this sideways consolidation period and maybe still some weakness ahead. Also, that 10-year Treasury yield needs to be watched. If that continues trending higher, that also could be a contributor to spooking the market in the near term. Moving on to the Russell 2000, the IWM. Still got that cup. Yesterday again, what did we do? We gapped down. I think I talked about this on the show yesterday. Last 2 days, we had gap downs, really nothing else to the downside. We finished very close to the open. And then yesterday, look at this hammer candlestick right on the 20-day moving average. That to me looks like a short-term bottom. We also have a channel coming up here. And if you look at the cup with handle pattern, normally the handle comes down maybe up to about 50% of the depth of this cup. And that's about where we were yesterday. So short term, it's always hard for me to argue with a secular bull market. I try to ingrain that in our members' heads over and over and over again. Even when I see weakness, potential weakness in the market, it's so difficult to bet against the bullish side of trading, because secular bull markets generally take no prisoners, and we continue to see up action, even though we have, multiple reasons to see perhaps more of a pullback. It just seems like one more piece of good news comes out and the market takes it away and, tries to break out again. That's really what we're going to be looking at today. Let's move on and take a look at the chart of the day. So first, I want to take you over to our website at EarningsBeats.com. A couple of things. You'll see the Boley trend market history. This is a free download. I just want to make sure that any of you who are new to the show, check that out. This is going back more than 70 years where I've tracked the daily action on the S&P 500, the Nasdaq, and also the Russell 2000. And this particular report really just looks exclusively at the S&P 500 and how the S&P 500 has performed over the years. So you can pick up on some really key historical trends with the S&P 500. Honestly, if you trade frequently, you don't want to not have this PDF, and it's completely free. Email address, name and email address really is all it takes, maybe just an email address, but click on that download free report and make sure you get that. If you want to learn a little bit more about how we approach the market, scroll down. We have a free newsletter, EarningsBeats Digest, name and email address, all it takes there, no credit card required. You can unsubscribe at any time. 3 times a week it comes out, and I'm looking at charts that I think are meaningful. Could be individual stocks, that could be setups for trades. We're not registered investment advisors, though. Not advising, not recommending. Any trades you make are certainly your risk and your responsibility, but we do try to provide education. That's the whole idea with a lot of what we do. It's market guidance, it's market education, it's market research. So that's what you're going to get from EarningsBeats. If you want to try our service out, our full paid service, there's a 30-day free trial. You can start that by clicking that green button. So what chart do we have for you today? Well, semiconductors. This has been the absolute best performing industry group over the last year. And you can see, look over at the left side of the chart, and for the most part, it's been going up over the last year. We did see some consolidation, even a little bit of selling over the summer and into maybe early fall when we had the correction. But other than that, we have just been going straight up in the semiconductors. Since the end of October, we're up probably in the neighborhood of, going from the low to the peak, probably somewhere in the neighborhood of about 60%. And that was over the course of 3.5 months. So this has been a strong group, but look at where it closed yesterday before the NVDA report came out. Right on the 20-day moving average. NVIDIA now going to light a fire under this group again. We're probably going to see a breakout, maybe even at the open, back above that 14,000 level. This is just a group that just doesn't want to quit. The earnings are supporting this. I hear a lot of people comparing what's going on to the dot-com bubble. This is so far away from the dot-com bubble. The only similarity is that they're both going up. I mean, there were so many companies that were getting, I don't remember what the market caps were, but we had some companies that had limited revenues, no earnings, in fact, big losses. They were getting naming rights to NFL stadiums. If you weren't around for that, it was literally just a party built on nothing, smoke and mirrors. Many of those companies had billions and billions of market cap, and all they would do is split their stock and the prices would just jump. There was nothing behind them. I ask you to look at the earnings report of NVIDIA and look at how much growth they've seen. And then if you understand anything about valuations, understand that valuations are based on 2 things, which is why the stock market is based on these same 2 things. It's earnings and interest rates. When interest rates are at very low levels, even though our rates have gone up, we're still at historic low levels. And so when you've got historically low levels of interest rates, and you've got companies like NVIDIA that are growing their companies so fast, you have to project out where an NVIDIA is going to be 5 years from now, and then discount those future cash flows or that future earnings growth back using today's low interest rates. And the lower the interest rates, the higher the valuations. This is nothing. This is absolutely nothing like year 2000 and the dot-com bubble. Somebody wants to talk about that, feel free, but turn the channel. All right. So looking at the semiconductors, I mean, obviously this slope that you're looking at right here is unsustainable. This trend line is unsustainable. So at some point it will break. And that will be the next time that everyone is, so bearish because, oh my gosh, the trend line broke on semiconductors. So if you're kind of looking at it, it would be something like that, maybe. And if we look at their most recent low on the most recent pullback at the end of January, you'll see that these two lines almost intersect close to the 12,500 level. So if we get back up to 14,000 this morning, or maybe even above, we'd have maybe about a 10% drop down to that area. Now, I suspect we're going to have some weakness in the stock market over the summer. That's kind of a typical thing that we see during a presidential election year. I think there's uncertainty going in, and certainly with Biden and Trump, most likely those two facing off again, we're probably going to see a lot of uncertainty. There's probably going to be a lot in the headlines, a lot of things maybe they're going to spook investors. And so I could see that coming later in the year. And again, that kind of lines up with history. Maybe at some point that's when we break this trend line, or maybe it's sooner, who knows. But just keep in mind that this trend line represents, if we take the low here and where the trend line is right now, over 3.5 months, this would be roughly 3,600, probably somewhere around 40%. In other words, we'd have to go up 40% every 3.5 months to keep this streak alive. That's unsustainable. Nothing goes up 40% every 3.5 months and keeps doing it. I mean, semiconductors try. They're probably the closest, but nothing goes up that rate. So when the trend line breaks, that's not the end of the world. It just means that this is unsustainable. So prepare yourself. At some point, this trend line will break and everyone will be down on semiconductors because, oh my gosh, they're not making 40% every 3.5 months anymore. Now they're only making 20% every 6 months. Wow, that's horrible. That's what we'll have to deal with when it happens. But for now, this group continues to be on fire. Their earnings absolutely are off the charts. And it's not just NVIDIA. Go back and look at Advanced Micro's report. Look at Applied Materials, which tends to be, a little bit more predictable. Their earnings just jumped. I mean, the whole group has been growing earnings rapidly, and that's going to lead to rapidly ascending prices, which is exactly what we've seen on this chart. All right. I want to go through a few things here. A couple of chart lists that we like to use at EarningsBeats. So if you do sign up for a 30-day trial and you're also a Stock Charts member, you don't have to be a Stock Charts member. But if you are, our service is even better because you can take some of our work, like this is our strong earnings chart list that I'll show you right now, has 390 companies on it. So there's 390 companies on the strong earnings chart list, which means these companies have beat revenues in terms of, they've beaten the revenue estimates in their latest quarter. They've beaten earnings per share estimates in their latest quarter. They're liquid. So I run scans to make sure that they trade at least 250,000 shares. Then I also kind of look, give it my own look to make sure that the volume, a 250,000 share day on a $5 stock is a little bit different than a 250,000 share day on a $1,200 stock. So total dollar volume is much different between the two. So if I've got a stock that's borderline on being liquid and it's a $5 or $7 stock, I don't include it. But if it's a $1,200 stock, maybe even averages a little under 200,000 shares a day. But again, I want to make sure that it's liquid. It goes on this list. And then I also look at technicals. Sometimes I'll put a stock on there that has a low scooter rank, Stock Charts technical rank. But for the most part, I would say most of the stocks I put on the strong earnings chart list at least have a 50 or 60 scooter, which means they're in the top half of, at least based on scooter scores, they're in the top half of relative strength within their asset class. But the thing is, if you are a Stock Charts member, what I was mentioning is you can actually download this chart list into your Stock Charts account. You have to be an extra or pro member. I think a basic member only allows you one chart list, I believe. And I think that's a default. They give you a default, so you can't add more chart lists. But if you're an extra or pro member, you can have, I think, up to like 250 or 350 chart lists. We don't have that many, so you don't have to worry. But we probably have, I'm going to guess 10 to 15 that you probably would want to download, maybe 20. But this is our strong earnings chart list. You can literally download all of our research. And by the way, every stock that I have on here, I annotate where I think key price support levels are. So go right here in the middle. This is one that more recently reported. But this is Waste Connections, gapped up. There's the top of gap support. And you can see the stock, after gapping up, kept going higher on big volume. I believe if it comes back down to about 162, that would be a pretty good area for entry. Possibly it goes down to fill the gap, but in my experience, when you gap up, normally if you're going to go back down to test that gap support and fill that gap, you usually do it pretty soon after reporting earnings, because when you gap up and everyone is buying, market makers are on the other side of that trade. And so if they're shorting, that's when you have the best chance for prices to pull back, because they tend to make money more than they lose it. But sometimes they take a short position and the volume overwhelms them. They don't have unlimited resources. So if the volume is too strong on that push to the upside, then market makers are forced to cover those short positions higher. They end up losing money. They don't make money on every trade. They lose money just like all other traders. But they do have a big advantage that we don't have, which is being the ability to see order flow. So I don't ever put anything past the market makers. And that's why when stocks gap up, I need to see which way they go after the market opens. I want to see the reaction, not just the day after earnings, but also for the next few days. So in the case of Waste Connections here, you can see the stock gapped up, probably sold off early. And I can pull up a 5-day chart and we can take a look at what happened back here. So here was the early action to the downside. And then you can see the stock take back off and finish at the high of the day. So we did see folks that were jumping in at the open quickly lost a few dollars. Maybe some of them decided they would sell and take the loss because it was such a rapid move to the downside. But you can see by the end of the day, and then for the next few days, we've been going higher. So you get back to that daily chart, and that 162 level for me, I think is a pretty big level. All right, let me go back to the strong earnings list. So what you can do is you can pull this up in summary form, and we can look at it a couple of different ways. Number one, you can rank them by scooter. Again, Stock Charts technical rank. This is it compares securities within the same asset class, with 100 being the highest level you can get, or maybe I don't even know if you can get 100, maybe it's 99.9. And then down at the bottom, 0.1 would be the lowest. So what you could do is sort this in scooter order, and then you can literally look down and see which stocks are among the best performers, and you're going to recognize many of them. But the thing you have to understand when they're on this list, it means that they beat forecasts, they beat consensus estimates in their latest quarter. And that's always a good thing, because in order to get your market valuation to rise, I believe Wall Street has to begin to believe that your estimates can be relied upon. And if you have a consistent tendency to beat those estimates, Wall Street is willing to put a premium on your stock. And that's where you get that relative strength from. So stocks that trade up in this range are doing that for a reason. Most of these stocks are overbought, and most investors won't buy them because they're going up too much. Well, they're going up too much because they're the best stocks to invest in. And yes, you're going to have some days where they're going to pull back and it's not going to be pretty. And maybe you save that. I mean, look at SMCI. Last 2 days, look at this move. We went up. This is the earnings that came out, and I'll stick by this. I think they had the best earnings report of the entire quarter, and maybe one of the top quarterly earnings reports I've ever seen. They completely annihilated revenue estimates, earnings estimates, and the growth from year to year was astounding for a company their size. I mean, they were probably about maybe $30 billion company down here. And by the time the next couple of weeks rolled around, they were probably 50, 60, maybe 70 billion. I don't know where they were at the high. But the stocks pulled back near the 20-day moving average. And this is a stock that actually, let me give you the pre-market number here. But SMCI is up $98 this morning. It is now back to 832. So here was the move. Here was basically a 20-day test, and now back off to the races. Don't be shocked to see this stock right back up at 1,000, maybe even breaking back up above these recent highs. I said, I think probably it's worth 1,500 or more based on the numbers they reported, unless this is some sort of a fluke, a one-quarter type thing. But it wasn't, because their annual revenues jumped crazy as well, and annual profits. This is a company that I believe over the long term could be a major, major, major winner. I mean, yes, you have to accept the volatility, and some of these stocks never grow into what Wall Street believes they're going to become. So a lot of this price action right now is not just based on last quarter's earnings, but this is based on future earnings. So if they start to come up short, then obviously this is going to turn out to be a dud for an investment. But you have that risk with every company that's starting to grow. Apple had that risk, and then you look at a company like BlackBerry, which looked like it was priced, to go a lot higher, and that one didn't make it. Just wasn't. They couldn't withstand the competition from Apple, and BlackBerry just languished and continues to languish. So you don't have a guarantee on any of these, but by investing in a lot of growth stocks, the QQQ, that's why you get so much better performance in the QQQ during a bull market than you get in the SPY. These growth stocks tend to accelerate in low interest rate environments and when the economy is strong or strengthening. So anyway, I just wanted to point that out. We have other chart lists as well. Here's our raised guidance chart list. So we can go down here. There's probably 300, 400 stocks on this list. I'll just randomly pick one. GIS. General Mills. So here was where they raised guidance. They haven't broken down. The problem with General Mills isn't necessarily what it's doing in terms of earnings and earnings growth or anything like that. It's a consumer staple stock. And look at a consumer staple chart. Stocks have been going nowhere. Discretionary has performed much, much better over the last few years. So that's part of what we have to evaluate as well, is what part of the market are these stocks in. Let me see if I can get a technology name that's on here. Here's one, TTD, that's Trade Desk. And that was when they just raised guidance. You can see with earnings, raising guidance, big jump, failed to make this breakout, might be coming back down toward this key area of support near the 20-day. Hard to tell. All right. Anyway, it is 9:28. Let me see if there's. Let's take a look at Garmin. Garmin came out with its earnings yesterday, and you can see the stock up a little bit, but I actually like this chart. This will be our last one. I'm kind of waiting to get the 9:30 market open and see where we open on all these indices. But you can see Garmin breaking out. Nice move up. Does have a long tail to the top, but notice what happened here. We gapped above this resistance level. So if we just kind of zero in, see the open right here at about 130? The high candle body previously was about 129. So when I get that kind of a signal, I treat it as a bullish signal. If I get a breakout on the open and the stock beat top line and beat bottom line, and especially if they raise guidance, this is the type of company that I believe is going to go higher in time. So if you do get a pullback, maybe eventually we get back to this 130 level, maybe even as the 20-day starts to move higher, we get a test of the 20-day. Those would be levels that I would consider owning a stock like Garmin or getting into a stock like Garmin. All right, it is 9:30. So let's see if we have an opening here. And we do. We have the Dow Jones currently. Actually, that's still showing yesterday on the Nasdaq. So let me keep going here. There we go. Nasdaq up 328 points, 2.11%. S&P 500 is at a new all-time high. 5,047 and something was the high, and we hit 5,048.67. So let's pull that up real quick. And 5,048. So the question here is, are we going to trade up from here and just extend these records? You know, the action on the S&P up in the new record high territory. That previous high actually was 5,048.39. Today, 5,051.37. So we have set a new high. We opened at 5,038, which was a new opening high or candle body high, it looks like. So my guess is we probably go higher. But remember, we do have a lot of warning signs still out there. Let's see what happens and see what kind of follow through we get today. But at least at the open, and you can see right now coming back down just a bit, 5,046. Let's pull up the QQQ, see where we are there. Right back up to these highs. Unable to get through though. Going to be an interesting day for sure. Let me go to the daily chart on the QQQ. That was just the most recent. So the high was up near 440. So we're not at the high. This one, I would suggest that, well, at least I would think that we're probably going to pull back. So maybe that S&P testing that 5,048 level. I mean, we could go higher, but with short-term signals that we have and the gap up, I feel like, you know, I don't know what percentage I'd put on it, maybe 55, 45. I hate to bet against the secular bull market, but we didn't break out here with the most important index of all. So I'm going to say that the odds are we go down from here today. Just a guess. So if I was in NVIDIA, for instance, I probably would just take the profits at the opening bell. Although it opened above, this is a tough call. Let's see where that SMCI is. Yeah, it gapped up. Oh my gosh, 854. It's up $120. I mean, they're throwing dollars around in some of these stocks. It's just like pretty crazy. But again, some of them came out with earnings that I believe they actually deserve these kind of valuation increases. So going to be an interesting day. Let's see where we finish. But at least NVIDIA getting off to a really good start, getting the whole market off to a great start. And actually, one last thing before we go, let's take a look at that semiconductor index. Yes, we did gap up and break out on the opening bell there. So pretty good action at the open. Can't argue. I said going in, I thought NVIDIA was going to have a blowout report, and it had a blowout report, and it's being rewarded for it. But let's see where we finish today. Anyway, everybody have a great rest of your day. It was a pleasure being with you again this morning. If you're new, make sure you like our video. That certainly helps us with the algorithms. And also subscribe to our channel. That way, if we have any other live shows or whatever, if you hit that subscribe button, then you can be notified. Make sure your notifications are on, and then you'll be notified of any of our live shows going forward. But again, any of those of you new, welcome to the show. And of course, those who have been supporting us over, the lifetime of EarningsBeats, we really, really appreciate your support and loyalty. And again, have a great rest of your day. Rest of the weekend, I'll be back for your next show on Tuesday. So let's see what happens, where the market is when I come back. Have a great day, everybody. Happy trading.